Hey, my name's Josh Walker, one of the owners of a REIT Investing. Today, we are going to talk about deal structure, syndicated deal structure. So, when thinking about different deal structures, think about this like a give and take. And what I mean by deal structure is essentially how are the investors and the sponsors going to get paid? So, we talk a lot about this, but think through this as far as what is important to you for you to get from where you are today to where you want to go and build your investment criteria around that. Certain deal structures will lend themselves more to higher cash flow deals or growth over time or more or less risk around certain types of the deal. So each deal structure shifts the risk around. One type may guarantee, and I use the word guarantee in its loosest term. Get pretty freaked out when people start throwing around the term guarantee, but we'll use it in its loosest sense. So one type of deal may guarantee a certain multiple of your investment, and then the sponsor keeps everything else. So in that type of a deal, you've shifted the risk away from how much am I going to make and more towards how long is it going to take me to make it. The alternative is also out there where there's there's no guarantee for how much you're going to make, but there's a ton of potential upside. So now the risk is around how much am I going to make, but there's probably a little more on the front end of a deal like that. So first we'll talk about a typical deal. And when I say typical, that's another loose term, but we'll talk about what's typical of most of the deals that we look at. So we'll start here because it's a good foundation to build other options off of. But know that the deal structure can be pretty much anything. It's completely up to the sponsor, however they want to structure their deal. But typical deal that we see, there's always going to be a minimum investment. These are typically $50 to $100,000. There's not going to be a deal with no minimum. No sponsor is going to let you invest $100 in a deal. So I've seen them as low as $10,000, maybe $5,000. I've seen them as high as $500,000. But typical is $50 to $100,000. There's also typically a preferred return. We've talked about this a little bit in the past, but a preferred return is the amount of profit that goes to the investor before the sponsor sees any of the profit. So when you think about the flow of money, it's always going to go to the bank first. The bank always gets paid first. There's also expenses that go towards the asset. And then there is the sponsor's management fee, and then there's profit. And a pref defines what percentage of the profit that you get before the sponsor sees any of the profit. So beyond the pref, and a typical pref is 6 to 9%. Beyond the pref, there's going to be a predefined split of the remaining profit. It's also referred to as a waterfall. So this might look like a pref is 8%. That all goes to the investor. All of that profit goes to the investor. And then after that, maybe it's an 80-20 split, with 80 going to the investor, 20% going to the sponsor. That is pretty typical. There can also be another layer or another threshold within that waterfall. So maybe it's a pref of 8% and an 80-20 split up to 15%. And then once the investors have received a 15% return, maybe then it goes to 60-40. And that's kind of viewed as a reward to the sponsor for delivering a significant return to the investors. Most of the deals that we look at, and this isn't necessarily part of the structure, but it certainly impacts it. Most of the deals that we look at are value add. We love value add deals because it's a way for the sponsor, for really, really good sponsors, to force appreciation, which can lead to a whole lot of growth over time. But know that in a value add deal, there's a renovation period and there's a stabilization period. So the renovation period happens pretty immediately. They close on the asset and they immediately start renovating the common areas. Maybe there's a pool, a clubhouse, those kinds of things, the lobby. And then as tenants move out, they upgrade each unit and then tenants move in and they increase the rent. So this is where you need to find excellent operational sponsors, because what typically happens during this time is your occupancy dips, because you're not just somebody moves out, somebody moves right back in. It takes some period of time to do these renovations, and there's only so many that they can do at a time. Even if 40 people move out on a single day, it likely doesn't make any sense for them to start renovating all 40 of those units, because that's going to take a significant amount of time. Your net operating income is going to go way down to the point that maybe it can hurt the sponsor's ability to service that debt, and that means they have to cut distributions. You want people who are experienced doing this, because they know, hey, we're only going to ever be renovating 5 units at a time, because we can handle that. We know how long it takes to renovate each unit. We're going to then raise the rent when people move back into it, and then we're going to renovate 5 more. And that increased rent is going to offset this. Maybe they can increase the number that they do over time because the previous renovations are already demanding more rent. But that's where the operational experience of a lot of these sponsors really, really comes in handy. You don't want them to rush through it, because it can have a detrimental effect to the net operating income, but you also don't want them doing one-off renovations and only doing them out of the cash flow from the asset, because that can take forever. A typical for a large multifamily apartment complex, typical is 18 to 24 months to do all the units, and I'm talking about like 100 unit, 120 unit, something like that, and up. But an inexperienced sponsor, it can fall apart, and it can take years, or it can be detrimental to the early time cash flow. But these types of deals tend to be, one of the reasons we like them is because they tend to be a good mixture of early time cash flow. It's not nothing typically. It's not crazy high, but it's decent, and a lot of upside in the long term. So that's a typical deal. Now let's talk about some things that are less typical, but not completely unheard of. So one of these is you might see deals that have A shares and B shares. And the typical difference between these is it's typically different for different levels of investment. So an A share might require a $100,000 investment, and a B share might require a $50,000 investment. The difference between these is typically the pref and the waterfall. So A shares, which required $100,000, and this is just an example, it can be anything, but maybe the A shares get a 10% pref and an 80-20 split forever. And maybe the B shares get an 8% pref and a 70-30 split. Like I said, it can be anything, but this is a way for the sponsor to incentivize others to invest at a higher level. So these are becoming pretty popular with some of your more sophisticated sponsors to find these ways to incentivize investors. You can also find, I call it a mixed option, or a upside versus no upside option. These are also becoming a little more frequent. So some deals have an option to where you get a flat return and no upside. So maybe the A shares get a 10% return, but that's what they're going to get. They're going to get 10% a year as long as the profit is there, and that will accrue if it's not there. And then upon the sale of the asset, they're going to get their capital back. So they've made 10%. They invested $100,000. They get $10,000 a year for a 5-year deal. They sell the asset. They get their $100,000 back. The B shares may get a lower pref. It may be as low as 6%, 7%, but they get all the upside. So you can typically not just typically they allow investors to invest on both sides if you want to do that. So if you're thinking about investing, say $150,000, you could put $100,000 in the A shares and $50,000 in the B shares and have a little bit of both sides. So um, but another example would be profit sharing with a cap. So typically, these will provide the investor with a certain percentage of profit until they hit a multiple of their investment. So think of this as a less risky return, but timing risk. This is kind of what we were talking about earlier. An investor may get 80% of the profit, which is crazy high just from day one, until they double their money, and then it's over. and then everything else goes to the sponsor. So a sponsor may structure something like that when there's a ton of potential profit and they only want to give up so much, but it's still a very, very good return for the investors. Um, these are typical for longer term deals. Think like neighborhood developments. They have the potential for very, very high multiples, but the timing can vary. Think about, the demand for lots can fluctuate greatly from year to year. Another type of deal structure is a JV or a joint venture. So in a JV, all parties are equal. These are not very common. These are typically done strictly with friends and family, people who know each other very well, because in a true JV, there's not a general partner and a limited partner. All the partners are equal, and all partners have equal operating rights and equal decision making rights. Those are a little less frequent. There's also debt deals. So think of these just as a simple loan. So these often have low minimums and they often have low relative risk. You often don't have to be an accredited investor, and there's no upside to take advantage of. It's simply a loan, and so sponsors might utilize debt deals when they have, for whatever reason they want. They don't want to give up as much equity. Now, where that shifts a lot of the risk, the early time risk, to the sponsor, because they have to service that debt. They can go into default if they don't service that debt. But on the back end, if they know what they're doing, they're a really good sponsor, they can service that debt, they protect all of the equity, or a more higher percentage of the equity for themselves in the long run. And another thing to keep in mind is bank financing. So some deals, not all, have bank financing. Most of the deals that we come across have bank financing. So a lot of these multifamily deals, they'll go to a bank and they'll get financing for 75, 80% of the deal. They have to raise the remaining 20%. They'll typically raise, and they should raise more than that 20% to cover operating costs and working capital. But anytime there's bank financing, look at the debt, look at how it's structured, and know that the bank always gets paid first. Sponsors always have the option. If things get sideways, they can turn off distributions to their investors. And sometimes it makes all the sense in the world to do that, even for the investor. Maybe they need to use those funds to further enhance the asset, and it's going to lead to a huge amount of growth over time, but know that the bank always gets paid first. They cannot turn off the bank debt. So think through these different types of deal structures, figure out what helps get you where you want to be faster, and then start looking at deals. We talk a whole lot about spending a little bit of time. It doesn't take forever. Just spend a couple of hours thinking through where you are today, how much capital you have to deploy, how much should be focused on cash flow, how much should be focused on growth over time, and then start looking into deals that'll save you tons of time in the long run. We'd love for you to rate and review this podcast. And if you want a whole lot more information like this, go to arete.investing.com, ARETE investing.com, and download your complete guide to syndicated real estate deals.